There is a simple, almost childlike question that holds the key to a fortune measured in the hundreds of billions of dollars. It's a question that bypasses the complexities of financial modeling, the noise of market predictions, and the endless quest for the next brilliant idea. It's a question that, once understood, reconfigures the very architecture of your decision-making, transforming you from a gambler chasing wins into a grandmaster who wins by simply not losing. The question is this: where am I going to die so I'll never go there? This isn't a morbid fixation. It is the cornerstone of an intellectual operating system so powerful, so contrary to human nature, that it has served as the silent engine behind the greatest wealth creation machine in modern history. It is the core principle of Warren Buffett and his partner Charlie Munger, a mental model they call inversion. And in a world that screams at you to be smarter, to be faster, to be more innovative, their advice is a quiet, profound whisper. Stop trying to be brilliant. Start trying to not be stupid. This journey is not about learning a new investment tip or a business hack. It is about rewiring your brain. We are taught from our first day of school to solve for X, to find the answer, to chase success. Our heroes are the innovators, the visionaries who saw the future and built it. We study their triumphs, we read their biographies, we try to emulate their path to glory. But this is a cognitive trap. By focusing only on the winners, we suffer from a blinding survivorship bias. We see the one startup that made it, not the 1,000 that perished with the exact same idea. We see the stock that went to the moon, not the countless others that crashed to zero. We are trying to navigate a minefield by only studying the footprints of the few who, by skill or sheer luck, managed to cross. Buffett and Munger chose a different path. They decided to get a map of the mines. They dedicated their intellect not to finding the path to success, but to identifying all the paths to failure and then simply avoiding them. This is inversion. It is the art of thinking backward. Instead of asking, how can I achieve success, you ask, what are all the things that could cause me to fail? And then you build a system to avoid those things. The result is that success becomes the only logical outcome that remains. It's a subtle shift in perspective, but it has the force of a tectonic plate. It is the difference between building a flimsy raft to chase a distant island and building an unsinkable ship by first studying every possible way a ship can sink. Today we are going to learn how to build that ship. We will deconstruct this powerful mental model into 5 distinct pillars, moving from its philosophical foundation to its practical application in your finances, your career, and your life. This is not just financial advice. It is a blueprint for durable success in any field, a system for avoiding stupidity that is far more valuable than any fleeting stroke of genius. Our first step is to understand the bedrock. Before the billions, before Berkshire Hathaway became a household name, there was a conversation between 2 men in Omaha, Nebraska. A conversation that would lay the intellectual foundation for everything that followed. This is the foundational principle of inversion, the simple idea that to find wisdom, you must first look for foolishness. It's a concept articulated best by Charlie Munger, who once summarized the duo's entire philosophy. It is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid, instead of trying to be very intelligent. This wasn't just a clever turn of phrase, it was their prime directive. It came from a deep appreciation for a fundamental truth. The world is complex, the future is unknowable, and the human mind is a deeply flawed instrument. Trying to be brilliant in a world governed by chaos and chance is a fool's errand. It's a game of lottery tickets. But avoiding obvious, repeatable mistakes, that is a game of skill. That is a game you can win. This principle traces its roots back to the 19th century German mathematician Carl Jacobi, who was known for solving difficult problems by following a simple strategy, man muss immer umkehren, which translates to invert, always invert. If you're stuck on a problem, Jacoby reasoned. Try turning it on its head. Instead of proving that a statement is true, try proving that its opposite is impossible. This simple flip often revealed a clear and simple path that was previously invisible. Munger, an intellectual omnivore, devoured this idea and made it the centerpiece of his approach to life and business. He realized that in the messy world of human affairs, it is infinitely easier and more effective to identify what causes failure than what causes success. Success is a complex cocktail of skill, timing, and luck. Failure, on the other hand, often has simple, recurring ingredients: excessive debt, a lack of discipline, acting outside your expertise, succumbing to emotion. The genius of Munger and Buffett was to make a list of these ingredients and vow to never, ever let them into their kitchen. This mental shift from pursuing good to avoiding bad is the first and most critical pillar of their entire system. The story that best illustrates this foundational thinking isn't a dramatic stock trade or a corporate takeover. It's a quiet, intellectual breakthrough that occurred long before the monumental success. It was in the early days of their partnership, a period of intense learning and the forging of their core investment philosophy. Picture the scene: Omaha in the late 1950s and early 1960s. Warren Buffett, having dissolved his initial partnerships, was building what would eventually become Berkshire Hathaway. Charlie Munger, then a successful lawyer, was running his own investment partnership. They were in constant communication, two minds sharpening each other like whetstones. They were voracious readers, not of stock market reports, but of history, biography, psychology, and science. They weren't looking for tips. They were looking for patterns of human behavior, for universal models of how the world worked. One day Munger stumbled upon the story of the great mathematician Carl Jacobi and his principle of invert, always invert. It was a thunderclap moment. He immediately called Warren. The conversation wasn't about a specific stock, it was about a way of thinking. Munger explained the idea. Instead of trying to figure out how to make a business great, what if they first figured out everything that could kill a business? What if, before they ever considered investing, they made a checklist of all the standard causes of corporate mortality? Things like taking on too much leverage, losing a patent, facing disruptive new competition, having a dishonest management team, or being in a dying industry. Their new approach became a pre-mortem. Before buying a single share, they would sit down and ask, let's imagine we buy this company, and in 5 years it's a total disaster. What would have happened? They would then list every conceivable cause of that failure. A new competitor entered the market. The CEO retired and his idiot son-in-law took over. A key product became obsolete. The brand reputation was damaged by a scandal. They would go on, building a detailed portrait of the company's demise. Only after they had exhaustively mapped out all the roads to ruin and satisfied themselves that the company had durable moats protecting it from those specific threats, would they even begin to consider the upside. This was revolutionary. At the time, Wall Street was obsessed with growth stories, with finding the next Xerox or IBM. It was a culture of pure offense. Buffett and Munger, sitting in their quiet office in Omaha, decided to build their empire on defense. They decided that the key to winning the game was not hitting home runs, but religiously avoiding strikeouts. This inversion thinking became their ultimate filter. It wasn't about being smart and predicting the future. It was about being wise and recognizing the timeless patterns of failure. They would later say that they didn't have a system for being smart. They had a system for avoiding being dumb. This simple, profound shift, born from a long-dead German mathematician and honed in conversations between two friends in Nebraska, became the genetic code for Berkshire Hathaway. It was the decision to map the minefield first, and it's the reason their ship has sailed through decades of market storms without ever taking on a fatal amount of water. The reason this inversion strategy is so powerful and so rarely practiced lies deep within the wiring of the human brain. We are fundamentally biased toward positive action and success stories. The primary cognitive bias at play here is survivorship bias. We systematically overestimate the chances of success because the failures are invisible. When we want to start a restaurant, we study the one successful cafe on the corner, not the 5 that went bankrupt in that same location over the past decade. The failures are gone. They don't give interviews, they don't write books. All we see are the survivors, creating a distorted perception of reality. Our brains draw a simple and dangerously wrong conclusion. If they can do it, so can I. We focus on what the winner did right, without ever seeing the subtle mistake the losers made that proved fatal. Inversion is a direct antidote to this. It forces you to actively seek out the failures. It makes you ask, why did those 5 other restaurants go out of business? The answers are often mundane but critical. Poor location, undercapitalization, bad service, inconsistent quality, not managing food costs. By identifying these failure points, you can build a system to avoid them. This process is less glamorous than drafting a visionary menu, but it is infinitely more important for survival. A related psychological pitfall is our brain's preference for addition over subtraction. When faced with a problem, our instinctive response is to add something new, a new rule, a new process, a new feature. We believe progress comes from doing more. Research has shown this addition bias is a cognitive default. Inversion, however, is a subtractive process. It's about removing the things that cause harm. Charlie Munger famously said, "Take a simple idea and take it seriously." The simple idea here is that removing negatives is often more effective than adding positives. For example, the best way to improve your health is not necessarily to add a complex new workout routine, but to subtract sugar and processed foods. The best way to improve your productivity is not to add a new app, but to subtract mindless web browsing and unnecessary meetings. This focus on subtraction is counterintuitive but incredibly effective. It simplifies the problem and often yields far greater results with less effort. It's a core principle of effective problem solving that is ignored by the vast majority of people who are constantly chasing the next new thing to add to their already cluttered lives and business strategies. This mental framework is the foundation of a sound CEO mindset, one that prioritizes resilience and durability over fleeting, flashy wins. So how do you translate this powerful philosophy into a practical tool for your own decision-making? The most direct application of inversion thinking is a technique known as a pre-mortem. A post-mortem, as you know, is what happens after a project fails. A group gets together to analyze what went wrong. The pre-mortem, pioneered by psychologist Gary Klein, is the inversion of this process. You conduct the analysis before you even begin. Here is the blueprint, a step-by-step guide to applying this mental model to any significant decision, whether it's a new business venture, a major investment, or a critical career move. Step 1. Clearly define your goal. Write down, in a single, unambiguous sentence, what success looks like. For example, within 3 years, our new software product will achieve $1 million in annual recurring revenue. The clarity is crucial. Step 2. Convene your team, or if you're working alone, set aside dedicated time. The premise of this meeting is critical. You must announce, imagine we are 3 years in the future. The project has failed. It has been an absolute, unmitigated disaster. It's a complete write-off, a total loss. This framing is not optional. It bypasses the brain's natural optimism and frees people from the social pressure to be positive and supportive of the plan. You are giving them permission to be critical. Step 3. Generate all the reasons for the failure. Go around the room and have each person, one by one, write down every single reason they can think of for why the project failed. No idea is too small or too outlandish. The server crashed and we lost all our data. Our main competitor released a similar product for free. The lead engineer quit to join a rival. The marketing message was confusing. The price was too high. The price was too low. We ran out of capital. A key assumption about the market turned out to be spectacularly wrong. Encourage a storm of negativity. This is the process of mapping the minefield. Step 4. Consolidate and prioritize the list. Group similar reasons together and identify the most plausible and most damaging potential causes of failure. You are not looking for every possibility, you are looking for the biggest vulnerabilities in your plan. You are searching for the jugular vein. Step 5. Systematically de-risk the plan. Go through your prioritized list of failure points, one by one, and ask a simple question. What can we do right now to prevent this from happening, or to reduce its impact if it does? This is where the magic happens. You might realize you need a better data backup system. You might need to build a stronger non-compete clause into your key employees' contracts. You might need to raise more capital up front to give yourself a longer runway. You are proactively turning your reasons for failure list into an action-oriented, how to avoid mistakes checklist. This pre-mortem process transforms your business strategy from a hopeful march toward a goal into a robust, resilient system designed to withstand the inevitable shocks and setbacks. It ensures your victory not by guaranteeing brilliant moves, but by systematically eliminating the stupid ones. To truly appreciate the power of this approach, we must examine its opposite, the path of the 99%. The antithesis of inversion is the vision board mentality. It is the pervasive belief that success is a matter of pure willpower and positive thinking. This is the world of hustle culture gurus and motivational speakers who tell you to think and grow rich by simply focusing all your energy on your desired outcome. They tell you to write down your goals, to visualize your success, to maintain a quote positive mental attitude at all times. While intention is important, this approach is dangerously incomplete. It's like trying to sail across the ocean by staring intently at the distant shore while ignoring the holes in your boat. The 99% are obsessed with the to-do list. Their days are filled with action items, meetings, and a frantic sense of being busy. They believe that activity equals progress. They chase every new opportunity, say yes to every request, and add ever more complexity to their lives and businesses. Their focus is entirely on offense, on adding more, on going faster. The tragic irony is that this constant forward motion often leads them straight into a predictable and preventable disaster. Consider the archetypal startup founder who follows this path. She has a brilliant idea and an infectious passion. She creates a stunning pitch deck filled with hockey stick growth projections. She visualizes ringing the opening bell at the stock exchange. Her entire focus is on the successful outcome. But she neglects to invert. She doesn't ask, what are the most common reasons startups like mine fail? If she had, she would have discovered the leading causes are things like running out of cash, not finding product-market fit, and co-founder disputes. Because she was only focused on the vision, she didn't raise enough capital, giving her no buffer for error. She was so in love with her product idea that she didn't rigorously test whether customers actually wanted it, mistaking polite praise for genuine market demand. And she partnered with a friend without ever having the difficult conversation about equity, roles, and what would happen if things went wrong. A year later, the company is out of money, the founders aren't speaking, and the brilliant idea is nothing more than a painful memory. She didn't fail because her vision was bad. She failed because she was ignorant of the most common pitfalls. She was trying to be intelligent, without first building a system to not be stupid. This is the path of the 99%, a path paved with good intentions, positive thinking, and completely avoidable failures. The financial consequences of this distinction in thinking are not subtle, they are monumental. They appear directly on the balance sheet, in the long-term performance of an investment portfolio, and in the ultimate valuation of a business. Let's quantify the impact of inversion thinking using a core principle of wealth management, the brutal math of compounding. Imagine two investors, Investor A, the 99%er, and Investor B, the inverter. Both start with $100,000. In year one, a bull market, Investor A chases a hot tech stock and makes a brilliant 50% return. His portfolio is now worth $150,000. Investor B, using inversion, avoids the speculative frenzy. She focuses on buying a durable, boring business at a fair price and makes a solid but unspectacular 15%. Her portfolio is worth $115,000. Investor A feels like a genius and mocks Investor B for being too conservative. In year 2, the market turns. The hot tech stock that Investor A owned craters, and his portfolio loses 40%. His $150,000 shrinks to just $90,000. He has now lost money from his original investment. Investor B's boring company, which sells a product people need in good times and bad, sees its stock dip a mere 5% in the downturn. Her $115,000 becomes $109,250. Over 2 years, the brilliant investor is down 10%. The not stupid investor is up over 9%. This is the tyranny of negative numbers. A 50% gain is wiped out by a much smaller 33.3% loss. A 40% loss requires a massive 66.7% gain just to get back to even. The inverter understands this. Their primary goal is not to capture every last ounce of upside. It is to avoid the large drawdowns that cripple a portfolio's ability to compound over time. Their entire business strategy is built around risk management. This single idea that avoiding a large loss is mathematically more powerful than achieving a large gain is the secret to all long-term wealth creation. It is how Buffett's capital allocation strategy at Berkshire Hathaway, which has often underperformed the market in roaring bull years, has produced one of the greatest financial records in history over the long run. By focusing on not losing, he has allowed the gentle, relentless magic of compounding to work uninterrupted for decades. The financial connection is direct and profound. Inversion thinking creates resilience. Resilience minimizes catastrophic loss. And minimizing catastrophic loss is the only guaranteed path to achieving extraordinary long-term financial freedom. Our second pillar builds directly upon this foundation. If the first rule of inversion is to avoid stupidity, the most practical way to do that is to have a very clear map of the areas where you are most likely to be stupid. This is the concept of the circle of competence, but viewed through the lens of inversion. Most people think of the circle of competence as an offensive tool, a way to identify your strengths so you can capitalize on them. This is true, but it's only half the story. In the Buffett and Munger framework, its primary function is defensive. It is not about knowing what you know. It is about having a brutally honest, rigorously defined understanding of what you don't know. The goal of drawing this circle is not to feel smart inside it. It is to give you a bright, flashing, unmissable warning sign about the vast territory outside of it where you are a guaranteed amateur. Charlie Munger explained it with his classic wit. We have 3 baskets for investing: in, out, and too tough. You don't have to be right about thousands of companies. You only have to be right about a few. The in basket is your circle of competence. The too tough basket is everything else, the vast universe of businesses, technologies, and investments that you don't understand with deep, intimate fluency. The inversion-based approach is to spend almost no time on the too tough basket. You don't try to get a little bit smarter about everything. You acknowledge your ignorance and simply stay away. This is not a sign of intellectual laziness. It is a sign of profound intellectual humility, which is the bedrock of wise decision-making. You don't get points for difficulty in investing or business. You get points for being right. And your odds of being right are dramatically higher inside your circle and catastrophically lower outside of it. By defining what's out, you are systematically avoiding the single greatest source of investment error, venturing into territory where you lack a true informational or analytical edge. It's a powerful form of risk management that keeps you from playing games you don't understand, games where you are almost certain to be the patsy. The most famous and financially significant application of this principle was Warren Buffett's decision to completely sit out the dot-com bubble of the late 1990s. It is impossible to overstate the immense psychological pressure he was under at the time. The world was changing. The internet was going to revolutionize everything. Tech stocks were soaring to unimaginable heights. Companies with no profits and in some cases no revenue were achieving billion-dollar valuations overnight. And Warren Buffett, the Oracle of Omaha, the greatest investor of his generation, was doing nothing. He was buying brick-and-mortar furniture stores and insurance companies. The financial press turned on him. Barron's famously ran a cover story in 1999 titled, "What's Wrong, Warren?" The article declared him a relic, a man whose folksy, value-based approach was hopelessly outdated in the new digital economy. He was a dinosaur, and the meteor of technology had arrived. His own shareholders at the Berkshire Hathaway annual meeting were growing restless, asking him why he was missing out on the easiest money ever made. Buffett's response was a masterclass in inverted thinking and the discipline of the circle of competence. He didn't say, "These tech companies are all going to fail." He said something far more powerful. "I don't know." He explained that he had no special insight into which of the hundreds of new internet companies would be the long-term winners. He couldn't look at a company like Microsoft or Intel or Cisco and, with the same confidence that he could analyze Coca-Cola or Gillette, predict what their competitive position and earnings would look like in 10 or 20 years. He knew that the technology was real and transformative, but he couldn't translate that into a reliable valuation for a specific business. In short, technology was in his too tough pile. It was outside his circle of competence, so he simply refused to play. His decision was a direct application of inversion. He wasn't asking, "How can I get rich from the internet?" He was asking, "How could I lose a catastrophic amount of money in this environment?" The answer was clear: by betting on a technology I don't fundamentally understand, at prices that are based on pure speculation rather than proven earnings. By avoiding that specific path to failure, he was willing to accept the consequence, which was looking like a fool for a few years. Then, in March of 2000, the bubble burst. The Nasdaq, which had peaked above 5,000, began a brutal collapse that would see it fall nearly 80% over the next 2 years. Trillions of dollars in speculative wealth evaporated. The new economy darlings went bankrupt. The very same magazines that had mocked Buffett were now running stories about his timeless wisdom. He hadn't predicted the crash. He had simply avoided the arena where a crash was both possible and, for him, completely unpredictable. He won by not playing. That is the circle of competence as a defensive weapon, and it saved his investors tens of billions of dollars. The psychological principle that makes the circle of competence so vital is its power to counteract the Dunning-Kruger effect. This is a well-documented cognitive bias wherein people with low ability in a specific domain tend to dramatically overestimate their competence. In short, they are too ignorant to recognize their own ignorance. We see this everywhere. The amateur investor who, after a few winning trades in a bull market, believes he's the next George Soros. The new manager who, after reading one book on leadership, thinks he knows more than a 20-year veteran. The Dunning-Kruger effect is a recipe for disaster because it encourages people to step outside their true area of expertise and make high-stakes decisions with an inflated sense of their own skill. It is a direct cause of catastrophic mistakes in business and finance. The circle of competence, when practiced with intellectual honesty, is a direct antidote. It is an act of forced humility. The exercise of drawing the circle forces you to confront the limits of your own knowledge. It makes you explicitly differentiate between a topic where you have a casual familiarity and a topic where you have deep, genuine expertise. True competence, the kind Buffett and Munger insist on, is not about being able to talk intelligently about a subject at a cocktail party. It's about knowing it so well that you understand its nuances, its history, its failure modes, and what the key variables are that will determine its future success. Another powerful cognitive bias at play is overconfidence. Success breeds overconfidence. When we succeed in one area, our brains naturally assume that our skill is transferable to other areas. A successful real estate developer suddenly thinks he's qualified to pick biotech stocks. A brilliant software engineer decides she can open a successful restaurant chain. This is often a fatal error. The skills required for success are often highly domain-specific. The circle of competence acts as a governor on this impulse. It serves as a constant reminder that your success in one field does not automatically translate to another. It encourages a healthy skepticism of your own abilities when you venture into new territory. This discipline is a core component of a successful CEO mindset, preventing leaders from diversifying their companies into areas they don't understand, a classic path to corporate ruin. By forcing a clear-eyed assessment of your true knowledge, you avoid the twin psychological traps of ignorance and arrogance, which are responsible for the vast majority of preventable failures. Building your own circle of competence is one of the most important intellectual exercises you can undertake. It is the foundation for any sound investing strategy or business strategy. Here is a practical, step-by-step blueprint for defining your own circle. Step 1. Conduct a knowledge inventory. Get a blank piece of paper and divide it into 3 columns: professional expertise, deep hobbies, and consumed knowledge. In the first column, list the skills and industries where you have direct, hands-on experience from your career. Be specific. Not just marketing, but direct response copywriting for e-commerce brands. In the second column, list any hobbies or interests that you have pursued with an obsessive level of detail for years. Maybe you're a vintage watch collector, a Civil War historian, or a competitive poker player. These are areas where you have put in the, quote, 10,000 hours. In the third column, list subjects you have studied deeply through books, courses, and documentaries, but where you lack hands-on experience. Step 2. Apply the fluency test. Now go through your list, and for each item, ask yourself a series of tough questions. Could I give a 2-hour lecture on this topic without any notes? Could I hold my own in a debate against a recognized expert in this field? Do I understand the history of this industry and the major technological and competitive shifts that have shaped it? Do I know who the major players are, what their competitive advantages are, and what the common failure modes are for businesses in this space? If the answer to these questions is not a resounding yes, cross it off the list. This test is designed to separate casual familiarity from true, deep competence. Step 3. Draw the circle. The few items that remain on your list constitute your circle of competence. It will likely be much smaller than you expected. This is not a cause for dismay. It is a cause for clarity. These are the areas where you have a genuine edge. These are the games you should be playing. Step 4. Define the boundary rules. This is the most critical step. You must create a set of explicit rules for how you will operate. For example, I will not make any active investment in a public company outside my circle of competence. Or, before launching a new business venture in an area outside my core expertise, I must partner with someone who has at least 10 years of direct experience in that field. Or, I will not take advice on a major financial decision from anyone whose own circle of competence I cannot clearly define and verify. These rules are your defense system. They are the practical application of inversion, designed to prevent you from making the number one mistake: being stupid in an area where you have no business being smart. Your circle is not static. You can and should work to expand it over your lifetime. But you expand it from the inside out, through deliberate study and experience, not by taking reckless flyers on things you don't understand. Now let us examine the antithesis, the well-trodden path of those who ignore this principle. This is the world of the FOMO investor, the investor driven by the fear of missing out. This individual treats the market like a casino. Their investing strategy is dictated by whatever is making headlines. When cryptocurrencies are soaring, they pour their money in. With little understanding of blockchain technology, monetary theory, or the difference between a utility token and a security token. When a meme stock is being pumped on social media, they jump in, mistaking a speculative frenzy for a sound investment. When a new technology like artificial intelligence becomes the hot topic, they buy any company with AI in its name, without any ability to differentiate between a firm with a genuine technological moat and one that is simply riding a narrative wave. The FOMO investor operates permanently and completely outside of any circle of competence. Their decision-making process is not based on analysis, but on emotion. Greed when things are going up, and panic when they are going down. They have no anchor of independent valuation, no deep knowledge to give them conviction during periods of volatility. They are, in the language of the market, weak hands. They are always the last to buy at the top and the first to sell at the bottom. I once knew a very successful dentist. He was brilliant in his field, had built a thriving practice, and was an expert in oral surgery. This was his circle of competence. In 2017, he saw his friends getting rich on Bitcoin. He felt a powerful sense of FOMO. He took a significant amount of his savings, money earned over decades of painstaking work, and bought various cryptocurrencies near the peak of the bubble. He couldn't explain how they worked, what their value proposition was, or how to properly secure them. He just knew they were going up. When the bubble burst in 2018, he panicked. Lacking any fundamental conviction, he sold everything near the bottom, crystallizing a massive loss. He violated the cardinal rule. He took money he had earned inside his circle of competence and gambled it away in a field where he was a complete novice. This story has repeated itself millions of times in every market cycle, with every new speculative asset. It is the inevitable fate of those who refuse to honestly define the boundaries of their own understanding. It is a path of guaranteed wealth destruction. The direct financial connection of staying within your circle is profound, and it goes beyond just avoiding losses. It is also the single greatest source of massive life-changing gains. The reason for this is a concept Buffett calls waiting for the fat pitch. In baseball, a great hitter like Ted Williams knew that the secret to a high batting average was not to swing at every pitch. It was to wait for a pitch in his sweet spot, the area where he knew he had the highest probability of getting a hit. He would let perfectly good pitches go by if they weren't in that zone. Investing in business are the same. You don't have to swing at everything. The market will throw thousands of ideas at you every year. By staying within your circle of competence, you are training yourself to only swing at the fat pitches, the rare, obvious, no-brainer opportunities that appear in an industry you understand inside and out. When that opportunity comes along, because you know the business so well, you can recognize it instantly and act with extreme conviction. You can make a large, concentrated bet because for you, it isn't a speculation, it's a near certainty. This is how fortunes are made. Not by making 100 small speculative bets on things you barely understand, but by making a few massive bets on things you understand perfectly. Consider the financials. A typical know-nothing investor is told to diversify. They might own a mutual fund with 500 different stocks. Their portfolio will, by definition, produce average returns, minus fees. They have outsourced their thinking. An investor who operates within their circle might only make 1 or 2 investments every few years. But when they do, they might allocate 15 or 25% of their entire capital to that single idea. Over a lifetime, they might only make 20 such decisions. But because these decisions are all fat pitches within their area of expertise, their batting average is incredibly high. The resulting portfolio is concentrated, but it is not risky. For them, risk is not volatility. Risk is the permanent loss of capital, which is highest when you don't know what you're doing. This CEO mindset, focusing on a few high-conviction decisions rather than many low-conviction ones, is how great businesses are built and how true wealth is generated. The financial advantage is therefore twofold. On the defensive side, you avoid the catastrophic losses that come from ignorant speculation. On the offensive side, you are uniquely positioned to act decisively and on a large scale when the perfect opportunity within your expertise presents itself. This brings us to our third pillar, which takes the abstract concept of inversion and applies it directly to the flow of money. This is where the philosophy meets the ledger. It is Buffett's most famous rule, the one that governs every single decision in his capital allocation strategy. Rule number 1, never lose money. Rule number 2, never forget rule number 1. To the casual observer, this sounds like a simplistic, even useless piece of financial advice. Of course you shouldn't try to lose money. But this is a profound misunderstanding of the principle. Buffett is not talking about the daily fluctuations of the stock market. He is not saying that a stock you own should never go down in price. He is talking about avoiding the permanent impairment of capital. He is talking about making decisions where the probability of a catastrophic, irreversible loss is as close to zero as humanly possible. This is inversion applied to the checkbook. Instead of asking, how much can I make on this investment, the first and most important question is, how can I lose money on this investment? You start by obsessing over the downside. You identify every possible way the investment could turn into a permanent loss. And you only proceed if you can build an ironclad case that those outcomes are highly unlikely. This focus on the negative, on what can go wrong, ensures that the base case scenario is survival. Only after you have rigorously protected your downside do you even begin to think about the upside. This reordering of priorities is the absolute core of Buffett's investing strategy and is the reason for his unparalleled long-term record. It transforms investing from a game of hitting winners to a game of not hitting losers. And because of the cruel mathematics of compounding, the latter is a far more reliable path to building wealth. A perfect illustration of this principle in action was Berkshire Hathaway's acquisition of See's Candies in 1972 for $25 million. On the surface, it didn't look like a typical Buffett investment. It wasn't a statistically cheap cigar butt company. It was a well-run, family-owned business being sold for what was considered a fair, even high price at the time, 3 times its book value. Many on Wall Street would have seen it as a boring, low-growth business with limited upside. But Buffett and Munger weren't looking at it through the lens of how much can we make. They were looking at it through the inverted lens of how could we possibly lose money on this. And when they analyzed it that way, they saw a fortress. First, they looked at the brand. See's Candies had a fanatical customer following in California. It was a beloved, trusted brand that people associated with holidays, gifts, and celebrations. This created what Buffett would later call a moat, a durable competitive advantage. Customers weren't just buying chocolate, they were buying nostalgia and affection. This gave the company immense pricing power. They could raise their prices a little bit each year to account for inflation, and their customers would barely notice or care. Second, they looked at the business model. It required very little capital to run. The candy was made, sold, and the cash was in the register. It didn't need massive investments in research and development or expensive new factories to grow. It was a cash-generating machine. So they asked themselves the inverted questions. Could a new competitor come in and destroy See's? Highly unlikely. The brand loyalty was too strong. Could the product become obsolete? Highly unlikely. People had been eating chocolate for centuries. Could a bad management team run it into the ground? Possible, but the business was so simple and robust that it was hard to mess up too badly. They concluded that while the upside might not be explosive, the probability of a permanent loss of their $25 million investment was virtually zero. They were buying a business that was almost guaranteed to be worth more every single year. That $25 million investment has since generated over $2 billion in pre-tax earnings for Berkshire Hathaway, cash that was then used to buy other great businesses. The See's Candies story is the perfect embodiment of rule number 1. They didn't make a brilliant prediction about the future of candy. They made a simple observation about the durability of a great brand and a simple business model, and focused all their energy on confirming that their initial capital was safe. The massive upside was simply a byproduct of not losing. The psychological principle that makes don't lose money so effective is its direct manipulation of our deep-seated loss aversion. The work of psychologists Daniel Kahneman and Amos Tversky proved that humans are neurologically wired to feel the pain of a loss approximately twice as powerfully as the pleasure of an equivalent gain. Losing $100 feels as bad as gaining $200 feels good. This cognitive bias has a massive impact on investor behavior. For most people, loss aversion manifests as panic. When the market falls, the intense pain of seeing their portfolio value decrease causes them to sell at the worst possible time, locking in their losses. They are reacting emotionally to the pain of temporary price declines. Buffett, however, inverts this principle. He leverages loss aversion not as a trigger for panic, but as a discipline for analysis. He channels that powerful emotional force into the asterisk pre-investment process. His intense focus on not losing money is a systematic way to front-load the pain. He forces himself to feel the potential agony of a permanent loss before he ever writes the check. This forces a level of analytical rigor and conservatism that is absent in the typical investor who is mesmerized by the potential pleasure of a gain. Furthermore, he makes a crucial distinction that most people miss: the difference between price volatility and fundamental business risk. The price of a stock can go down 50%, and if the underlying business is still sound and generating cash, you haven't lost anything. You've simply experienced volatility. A permanent loss of capital occurs when the business itself deteriorates, when its earnings power is permanently impaired. The 99% confuse these two things. They panic when prices fall. Buffett, having already done the work to ensure the business is durable, sees falling prices not as a risk, but as an opportunity. His inversion of loss aversion turns a psychological bug into a feature. It makes him terrified of buying a bad business at any price, and fearless when a great business he already owns goes on sale. This is the mindset that separates the amateur from the professional in the world of capital allocation. The blueprint for applying this principle to your own investments is the margin of safety, a concept first taught by Buffett's mentor Benjamin Graham. The margin of safety is the ultimate tool for obeying rule number 1. It is a simple, powerful framework for ensuring you don't overpay for an asset, which is the most common path to a permanent loss of capital. Here is the step-by-step process. Step 1. Calculate the intrinsic value of the asset. This is the most important step. You must determine what the business or asset is actually worth, independent of its current market price. For a business, this involves analyzing its earnings power, its assets, its debt, and its future prospects, and then discounting those future cash flows back to the present day. The key is to be brutally conservative. Use pessimistic assumptions. You are not trying to find the most optimistic scenario. You are trying to find a rock-solid floor value that you can rely on. This is your best estimate of the business's true worth. Step 2. Insist on a significant discount. Once you have your estimate of intrinsic value, you do not pay that price. You wait until the market offers you the asset at a significant discount to that value. Ben Graham suggested a discount of 33 to 50%. So if you calculate that a business is worth $100 per share, you would only be willing to buy it if the stock price fell to somewhere between $50 and $67. Step 3. Understand the purpose of the margin. This discount, this gap between intrinsic value and your purchase price, is your margin of safety. It is crucial to understand that its purpose is to increase your profits. Its purpose is to protect you from being wrong. Your calculation of intrinsic value is just an estimate. You might have made a mistake. The future might turn out worse than you expected. The margin of safety is your buffer. It's the shock absorber that protects your capital from bad luck, bad timing, or your own analytical errors. It is the practical, numerical application of the rule, never lose money. By refusing to invest without a substantial margin of safety, you are building a firewall against permanent capital impairment. Even if things turn out worse than you thought, the discount gives you a cushion. And if things turn out as you expected, or even better, your returns will be spectacular. It is a strategy designed for downside protection first, with the upside taking care of itself. This is the single most important piece of financial advice for anyone looking to build serious wealth over the long term. To fully grasp the wisdom of this approach, we need to look at its antithesis, the growth at any price philosophy. This was the dominant investing mania of the last decade, particularly in the tech sector. This philosophy inverts Buffett's rule. It places 100% of its focus on the potential upside and almost completely ignores the possibility of permanent loss. The growth at any price investor buys story stocks. These are companies with compelling narratives about disrupting industries and changing the world, but they often have little to no revenue and zero profits. Their valuations are not based on current earnings, but on speculative projections of what their earnings might be a decade in the future. The conversation is always about the total addressable market, or TAM. This company is disrupting the $10 trillion global shipping industry. If they capture just 1% of that, they'll be a $100 billion company. This kind of thinking is pure intoxication. It mistakes a good story for a good business. The investor pays a price that assumes not just that everything will go right, but that everything will go spectacularly right. There is no margin of safety. There is, in fact, a margin of danger. You are paying a premium for perfection. Consider the fate of many of the high-flying, innovative companies that went public in 2020 and 2021. They were hailed as the future. They had charismatic founders, slick presentations, and stories that were easy to fall in love with. Investors, caught in the speculative fever, paid prices that were hundreds of times their annual sales, let alone profits. They were focused entirely on the dream. They failed to invert. They didn't ask the simple, boring questions. What is the path to profitability? What happens if interest rates rise and capital is no longer cheap? What happens when deep-pocketed competitors decide to enter this market? What if their technology isn't as revolutionary as they claim? When the economic environment shifted, the dream turned into a nightmare. These stocks collapsed by 80, 90, or even 95%. The capital invested in them was not just volatile, it was permanently impaired. The companies ran out of money and went bankrupt, or were acquired for pennies on the dollar. The growth at any price path is a siren song that lures investors onto the rocks of permanent capital loss. It is the direct and disastrous opposite of building your decisions on the bedrock of a margin of safety. The direct financial connection here is the creation of an asymmetric risk profile for your portfolio. This is a concept that every sophisticated professional in wealth management and capital allocation understands. An asymmetric bet is one where the potential upside is significantly greater than the potential downside. By always insisting on a margin of safety, you are systematically constructing a portfolio of asymmetric bets. Let's make this tangible. Suppose you analyze a company and determine its intrinsic value is $100 per share. You then wait, with discipline, until a market panic allows you to buy it for $50 per share. What is your risk-reward profile? Your downside is arguably limited. You have bought the asset for half of what it's worth. For you to suffer a permanent loss, the business would have to deteriorate so badly that its intrinsic value falls by more than 50% from your already conservative estimate. This is possible, but unlikely for a durable business. So let's say your realistic downside is perhaps 10 or 20%. Your upside, however, is 100%, just for the stock to return to its conservatively estimated intrinsic value. And if the business grows over time, your upside could be many multiples of that. You are in a position where you are risking a little to make a lot. Now compare this to the growth at any price investor. They buy the same stock, but during a euphoric period, they pay $200 per share for it, betting it will go to $400. Their downside is catastrophic. If the stock simply returns to its intrinsic value of $100, they lose 50% of their capital. If the company stumbles, they could lose everything. Their upside is, at best, 100%, but their downside is enormous. They are risking a lot to make a little. Over time, a portfolio built on the first strategy, the margin of safety approach, will inevitably and dramatically outperform a portfolio built on the second. It creates a powerful tailwind for your finances. You generate steady, solid returns in good times, but more importantly, you preserve your capital during the inevitable bad times, leaving you with more money to deploy when opportunities are most attractive. This is how intergenerational wealth is built. It is not through reckless speculation, but through the disciplined, inverted process of eliminating downside risk first. Moving beyond the world of finance, our fourth pillar demonstrates how inversion can be one of the most powerful tools for personal and professional productivity. The modern world bombards us with the idea that the key to success is to do more. More tasks, more projects, more networking, more side hustles. The result is a culture of perpetual busyness, where people are drowning in to-do lists and overwhelmed by commitments. The inversion of this is the not-to-do list. The principle is simple. What you choose not to do is just as important, if not more important, than what you do. True effectiveness is not about managing your time better to cram more activities into your day. It is about ruthlessly eliminating the activities that don't matter. It is a subtractive process that creates the space and focus required for truly meaningful work. Buffett and Munger are masters of this. Their schedules are famously empty. They spend the majority of their days just sitting and reading. They are not in back-to-back meetings. They are not managing sprawling teams. They have inverted the typical CEO's calendar. They have realized that their job is not to do more, but to think better. And the prerequisite for deep thought is unstructured time. By creating a powerful not-to-do list, don't attend meetings without a clear agenda. Don't follow the stock market daily. Don't get involved in the operational details of their businesses. They free up their cognitive bandwidth for the few high-leverage decisions that truly drive value. This is a radical reimagining of what it means to be productive, moving the focus from activity to impact. The most famous story illustrating this concept is an exchange between Buffett and his personal pilot, a man named Mike Flint. Flint had been flying for Buffett for 10 years and was having a conversation with him about his career goals. Buffett, in his typical role as a mentor, decided to walk him through an exercise. First, Buffett said, "Write down your top 25 career goals." Flint spent some time thinking and carefully wrote down everything he wanted to accomplish professionally. When he was done, Buffett told him, "Now, review your list and circle your top 5 goals, the 5 that are most important to you." This was a harder task for Flint. It required him to really prioritize. After some deliberation, he circled his 5 most crucial ambitions. He now had 2 lists, the top 5, which he labeled List A, and the remaining 20, which became List B. Buffett then asked him, "So what are you going to do with List B?" Flint replied, "Well, the top 5 are my main focus, but the other 20 are still important. I'll work on them intermittently when I have spare time. They are things I still want to get done." Buffett's response was sharp and immediate. "No, Mike, you've got it all wrong. Everything on List B is now your avoid-at-all-cost list. You don't work on these, you don't think about them. You don't devote a single ounce of energy to them until you have successfully accomplished your top 5. This is the brutal but brilliant logic of inverted productivity. The 20 items on List B were not harmless, secondary goals. They were the most dangerous things in Mike Flint's life. Why? Because they were interesting enough to be tempting, but not important enough to be truly meaningful. They were the good ideas that would constantly distract him from the great ones. They were the seductive time wasters that would prevent him from achieving excellence in the things that mattered most. This is a profound insight into success habits. Success is not achieved by pursuing 100 different goals. It is achieved by choosing a tiny handful of priorities, and then systematically and ruthlessly eliminating everything else. Your not-to-do list is more important than your to-do list because it is the guardian of your focus. The underlying psychological principles that make a not-to-do list so effective are decision fatigue and the paradox of choice. Decision fatigue is the idea that our capacity for making rational, high-quality decisions is a finite resource. Like a muscle, it gets tired with overuse. The more decisions you make throughout the day, what to wear, what to eat, which email to answer first, the more your cognitive resources are depleted. By the end of the day, you have less mental energy available for the big, important decisions that actually shape your future. This is why many people find themselves making impulsive choices or procrastinating on important work in the evening. Their willpower is exhausted. A not-to-do list is a powerful antidote to decision fatigue. It automates a huge number of choices. If you have a rule on your list that says don't check email before 10 a.m., you have eliminated dozens of small, energy-sapping decisions from your morning. If another rule says Don't attend any meeting that doesn't have a pre-circulated agenda and a stated goal. You have created a filter that automatically protects your most valuable asset, your time and attention. The paradox of choice, a concept popularized by psychologist Barry Schwartz, describes how having too many options can lead to anxiety, indecision, and dissatisfaction. A person facing 3 choices is more likely to make a confident decision than a person facing 30. The modern entrepreneur or professional faces a near-infinite number of choices every day. Which new marketing channel to try, which software to adopt, which networking event to attend. This abundance of good options is paralyzing. It leads to a state of constantly dabbling in many things, but mastering none. The not-to-do list, particularly as derived from the Buffett 25/5 rule, is a solution to this paradox. It forces you to make the hard choices up front. By explicitly defining the 20 goals you will not pursue, you are liberating yourself from the anxiety and distraction they would otherwise cause. You are intentionally constraining your options to amplify your focus. It's a strategic act of simplification that preserves your mental energy for the battlefield where it actually counts. Here is a practical blueprint for creating and implementing your own not-to-do list, a key tool for any entrepreneur or leader with a CEO mindset. The process has 2 parts: identifying your personal productivity drains and defining your strategic avoidances. Part 1. The Productivity Drain Audit. For 1 week, keep a detailed log of how you spend your time. At the end of the week, review the log and identify recurring activities that left you feeling drained, unfocused, or unproductive. These are your primary targets. For each activity, ask the inverted question: what is the long-term negative consequence of completely stopping this? You will find that for many of them, like mindlessly scrolling social media, attending status update meetings where you have nothing to contribute, or responding to emails that don't require your specific input, the negative consequence is 0. These items go directly onto your not-to-do list. For example, do not open social media during work hours. Do not say yes on the spot to any new commitment. Always say, let me check my calendar and get back to you. Part 2. The Strategic Avoidance List, the 25/5 exercise. Follow the exact process Buffett gave his pilot. Write down your 25 most important long-term goals. Circle the top 5. The other 20 now become your strategic avoidance list. This is not about small daily tasks. It is about major life and career directions. It might mean saying no to a tempting but secondary business idea, turning down a board position that isn't aligned with your core mission, or ceasing to pursue a hobby that is consuming too much of your time. This list should be reviewed quarterly. These are the seductive distractions you must actively fight against. Step 3. Implementation and enforcement. A not-to-do list is useless if it isn't enforced. Place it somewhere you will see it every day, on your desk, as your computer wallpaper. Create systems to support it. Use website blockers to enforce your no social media rule. Set up an email autoresponder that manages expectations about your response time. Most importantly, practice saying no. It will feel uncomfortable at first, but every no to a low-priority request is a yes to your most important work. This is not about being lazy or unhelpful. It is about being a strategic allocator of your own life energy. The antithesis to this disciplined approach is the hustle culture entrepreneur. This is the individual who has been sold a bill of goods by social media influencers who glorify a lifestyle of constant, frantic work. Their identity is wrapped up in being busy. They wake up at 4 a.m., post about their grind on Instagram, and fill their days with a chaotic whirlwind of activity. They say yes to every podcast interview, every coffee meeting, every new idea. They believe that if they just work harder and longer than everyone else, they will inevitably succeed. Their to-do list is a mile long, and they wear their exhaustion as a badge of honor. This person is the polar opposite of Buffett and Munger. While they appear incredibly productive on the surface, they are often profoundly ineffective. Because they are doing everything, they are achieving excellence in nothing. Their attention is fragmented across a dozen different projects, ensuring that none of them receive the deep, focused effort required for a breakthrough. They are confusing motion with progress. They are running on a hamster wheel, mistaking their speed for forward movement. The inevitable result of this path is burnout. The human mind and body are not designed for a perpetual state of high-alert, caffeine-fueled sprinting. Eventually, the hustle culture entrepreneur crashes. Their health suffers, their relationships fray, and their business, which was built on a foundation of frenetic energy rather than strategic thinking, stagnates or collapses. They failed because they never learned the power of subtraction. They were so busy adding things to their plate that they never stopped to ask if they were eating the right meal. They mastered the art of doing, but never learned the art of not doing, and that ultimately was their undoing. This is a cautionary tale for any ambitious person. Busyness is not a proxy for importance, and a full calendar is often a sign of a cluttered mind. The financial connection of a not-to-do list is one of the most underappreciated concepts in business and personal finance: opportunity cost. Every hour you spend on a low-value activity is an hour you cannot spend on a high-value activity. The cost of that low-value activity is not just the hour you wasted, it is the lost value of the great work you could have been doing instead. Let's quantify this to make it real. Imagine you are an entrepreneur or a highly skilled professional, and you determine that the tasks that generate the most value for your business, things like negotiating major deals, designing new products, or creating a marketing strategy, are worth $1,000 per hour. Now, let's say you spend 2 hours every day answering routine customer service emails, a task that could be outsourced for $25 per hour. On the surface, you might think you are saving $50 by doing it yourself. But the economic reality is devastating. You are spending 2 hours of your $1,000 time on a $25 task. The opportunity cost is $975 per hour, or $1,950 per day. That's nearly $500,000 a year in lost value, simply because you have not put answering routine emails on your not-to-do list. This is the hidden financial drain that plagues millions of smart, hardworking people. A not-to-do list is, therefore, a high-leverage financial tool. It is a system for forcing you to allocate your most finite and valuable resource, your focused time, to the activities with the highest possible return. By systematically eliminating, delegating, or automating low-value tasks, you are directly increasing your effective hourly rate and your overall earning potential. It is the business strategy of focusing your firepower on the most critical targets instead of spraying bullets randomly in all directions. For an entrepreneur or a CEO, their primary job is capital allocation, and the first and most important form of capital they must allocate correctly is their own attention. The not-to-do list is the budget for that capital. This leads us to our fifth and final pillar, the one that ties all the others together. This is where we examine inversion not just as a strategy, but as a master tool for debugging the human mind. The human brain is an incredible machine, but it is riddled with cognitive biases, systematic patterns of deviation from norm or rationality in judgment. These biases are like software bugs in our mental operating system, and they cause us to make predictable, repeated errors in decision-making. Overconfidence, confirmation bias, herd mentality. These are the hidden forces that derail investors, ruin businesses, and lead to poor life choices. Inversion, when practiced habitually, is perhaps the most powerful and universal cognitive debiasing tool that exists. It is a conscious, deliberate effort to counteract the brain's laziest and most dangerous tendencies. By forcing yourself to think backward, to consider the opposite, to argue against your own most cherished ideas, you are shining a disinfecting light on the dark corners of your own mind. You are systematically searching for the bugs in your own thinking before they can cause a crash. This is the highest level of the art, moving from using inversion as a tactic for specific problems to adopting it as a default mode of thinking. It is about becoming a person who is constantly asking not just, "Am I right?" but more importantly, "How might I be wrong?" One of the most powerful ways this plays out at Berkshire Hathaway is Munger's role as the designated abominable no-man. His job is often to actively try to kill the ideas that Buffett brings to him. While others might be focused on all the reasons a potential acquisition could be a home run, Munger's first instinct is to invert. He takes on the role of the ultimate skeptic and builds the most intellectually rigorous case possible for why the deal is a terrible idea. This is not about being a pessimist, it is about being a realist. It is a systematic process for stress testing an idea. The story of Berkshire's purchase of Dexter Shoe Company is a perfect example of what happens when this process fails. In 1993, Buffett bought Dexter Shoe for $433 million, paid for entirely with Berkshire Hathaway stock. At the time, Buffett thought it was a great business with a durable moat. But he failed to adequately invert. He failed to ask the tough question, what could fundamentally destroy this business's competitive advantage? The answer, which became painfully obvious in hindsight, was low-cost foreign competition. The moat he thought was deep and wide was in fact easily crossed by manufacturers in other countries. The business collapsed, and Berkshire had to write off the entire investment. Buffett later called it the worst deal he ever made. But the real cost was far greater. Because he had paid with Berkshire stock, which subsequently appreciated enormously, the true economic cost of that single mistake was measured in the billions of dollars. He has since said that this painful failure reinforced the importance of Munger's role and the absolute necessity of inverting every single assumption. A deal must be able to withstand the most brutal, intellectually honest assault you can throw at it. If it can't, you walk away. The process of actively trying to kill the idea is the ultimate defense against falling in love with your own narrative. The two most pernicious cognitive biases that this kill the idea approach defeats are confirmation bias and the availability heuristic. Confirmation bias is our natural tendency to search for, interpret, favor, and recall information in a way that confirms our pre-existing beliefs. If you believe a certain stock is a great investment, your brain will subconsciously filter the news. You will notice and remember the articles that support your thesis and ignore or dismiss the ones that challenge it. You are not seeking truth, you are seeking affirmation. This is an incredibly dangerous way to make decisions, as it insulates you from reality. Inversion is a direct assault on confirmation bias. By forcing yourself to build the case against your own idea, you are compelling your brain to do the one thing it hates doing: actively search for disconfirming evidence. You are essentially paying as much attention to the reasons you might be wrong as you do to the reasons you might be right. This single habit, more than any other, is what separates consistently successful decision-makers from the rest. The availability heuristic is another mental shortcut that often leads us astray. We tend to overestimate the importance of information that is easily available to us, usually because it is recent, vivid, or emotionally charged. A plane crash makes the news, so we become more afraid of flying than driving, even though driving is statistically far more dangerous. In business, a recent success story of a company in a particular industry might cause us to overestimate the odds of our own success in that same industry, blinding us to the more relevant but less available base rate of failure. Inversion helps combat this by forcing a more systematic and less emotional analysis. When you ask, "What are all the ways this could fail?" you are no longer relying on the most available mental image, the recent success story. You are forcing yourself to do the harder work of researching the historical failure modes, the boring statistical realities, and the less glamorous, but more likely, outcomes. It replaces a vivid narrative with a logical framework, which is the essence of sound problem-solving. So how can you build this institutional skepticism into your own decision-making process, especially if you don't have a Charlie Munger sitting next to you? The answer is to create a red team. This is a concept borrowed from military and intelligence communities, and it is a powerful blueprint for any entrepreneur, CEO, or investor. A red team is an individual or group whose sole purpose is to challenge a plan and identify its weaknesses. Here is how to implement it for a major decision, such as a large capital allocation, a new product launch, or a strategic pivot. Step 1. Form the red team. After you and your main team have developed a plan of action, Select 2 or 3 trusted individuals who were not involved in creating the original plan. They should be intelligent, skeptical, and not afraid to challenge authority. Their official mandate is to be the opposition. Step 2. Arm them with information. Give the red team all the data, research, and assumptions that went into the original plan. Their job is to use your own information against you. They're looking for flawed assumptions, overlooked risks, and logical inconsistencies. Give them a specific amount of time, a day, a week, to prepare their case. Step 3. Hold the red team hearing. This is a formal meeting where the red team presents its case. Their goal is to convince you that your plan is a terrible idea and will lead to disaster. The most important rule of this meeting is that the original team is not allowed to rebut or argue during the presentation. They must simply sit, listen, and take notes. This prevents the discussion from devolving into a defensive argument and forces them to truly hear the counter-arguments. Step 4. Reevaluate and strengthen the plan. After the red team has presented its case, you can open the floor for discussion. Go through each of their points. Are they valid? Do they expose a real weakness? This is not about winning an argument. It is about finding the truth. The outcome of this process is one of 2 things. Either the red team exposes a fatal flaw that causes you to abandon the plan, saving you from a costly mistake, or they identify weaknesses that you can now proactively address, making the final plan far more robust and resilient. This structured process for inverting your own thinking is a way to institutionalize the kill the idea mentality and is one of the most effective decision-making tools you can adopt. The antithesis of this intellectually honest process is the visionary CEO who surrounds themselves with yes-men. This is a tragically common path to corporate ruin. The leader, often charismatic and brilliant, develops a powerful vision. They become so attached to this vision that they begin to see any form of dissent or skepticism as a sign of disloyalty. They promote people who agree with them and sideline or fire those who raise uncomfortable questions. A culture of fear and conformity sets in. Bad news is suppressed. Unflattering data is ignored. No one wants to be the messenger who gets shot. The entire organization becomes a giant confirmation bias machine, a self-reinforcing echo chamber designed to affirm the leader's brilliance. The results are predictable and spectacular failures. Think of the culture at Enron, where financial deception was hidden behind a veneer of innovation and success. Think of the downfall of WeWork, where a charismatic founder's messianic vision was enabled by a board and executive team that failed to challenge wildly unrealistic assumptions and a broken business model. These were not failures of vision, they were failures of inversion. There was no red team. There was no Charlie Munger whose job it was to say, "This is a stupid idea and here's why." Everyone was so busy admiring the emperor's new clothes that no one dared to point out he was naked. This is the danger of unchecked optimism, and the reason why a culture that encourages vigorous, intellectually honest debate is not a nice-to-have, but an essential survival mechanism for any organization. The path of the yes man is always, eventually, the path to the cliff. The direct financial connection of this cognitive debiasing process is perhaps the most significant of all. It can be measured in the value of the catastrophic mistake you don't make. While it's difficult to put a precise number on a failure that was avoided, the impact is undeniably massive. Let's use a clear, quantifiable example. A mid-sized manufacturing company is considering a $50 million acquisition of a smaller competitor. On paper, it looks good. The deal promises synergies, increased market share, and growth. The CEO and his team are excited. They have a bad case of deal fever. They are suffering from confirmation bias, focusing only on the potential upside. But then, they decide to run a red team exercise. The red team is tasked with killing the deal. They dig deep into the target company's financials, its customer contracts, and its operational liabilities. They discover something the original team had missed. The target company's largest customer, representing 40% of its revenue, has a clause in their contract allowing them to terminate for convenience if the company is acquired. The red team argues that there is a high probability this customer will leave, and that the synergies the deal team is projecting are pure fantasy. The CEO, confronted with this brutal, disconfirming evidence, decides to kill the deal. A year later, they learn that the competitor was indeed acquired by another firm. The large customer immediately terminated their contract, and the acquirer was forced to take a massive write-down on the failed investment. By spending a week on a red team exercise, the first company avoided a $50 million mistake. That single no, born from the disciplined process of inversion, created $50 million in shareholder value. It didn't show up as a profit on the income statement, but it was just as real. This is the hidden genius of Buffett and Munger's approach. Their fortune was built as much on the bad deals they didn't do as on the good deals they did. The systematic avoidance of stupidity, powered by the mental model of inversion, is the ultimate form of risk management and the most reliable engine for long-term financial success. You have just been given a powerful weapon. What we have explored today is more than just a piece of financial advice. It is a complete mental operating system. The principle of inversion, the art of thinking backward to systematically avoid stupidity, is the master key that unlocks durable success. You now understand not just the what, but the why. You've seen how it formed the bedrock of the Buffett-Munger partnership, how it translates into the defensive power of the circle of competence, how it manifests in the ironclad rule of never lose money, how it declutters your life through the not-to-do list, and how it acts as the ultimate debugging tool for your own mind. You have acquired a mental model that the vast majority of people will never discover, a tool that allows you to navigate a complex world not by chasing fleeting moments of brilliance, but by building a resilient system that wins by default. You have invested your time, and in return you have been given the blueprint to an intellectual fortress. But here is the critical truth you must now confront. What you have just mastered, as powerful as it is a single node in a much larger network of thinking. Warren Buffett and Charlie Munger's success is not the result of one mental model, but of a lattice work of interconnected models, borrowed from every discipline of science and life. Inversion is the foundation, the defensive architecture, but it works in concert with other models. Models for understanding value, for assessing management, for harnessing the power of incentives, and for understanding the psychology of markets. You have just forged the shield. But a complete warrior needs more than just a shield. You have built the foundation of the skyscraper, but the work is not yet complete. The path to true mastery lies in connecting this principle to the others, in building the rest of the structure upon this solid ground. The video that is now appearing on your screen is not an accident. The algorithm has analyzed your commitment to this deep level of thinking, and it has identified the next logical step in your journey. Think of what you've learned today as a single crucial piece of a map. That video is the next piece. It holds the link, the connecting principle that will take the defensive power of inversion and integrate it with the offensive strategies of a master capital allocator. It is the bridge between how not to lose and how to win decisively. It contains the knowledge that will allow you to complete the circuit to build the next level of your mental arsenal. The choice you face right now is more than just a click. It is a declaration about who you are. The person who is merely curious, who dabbles in ideas, will stop here. But the person who is truly committed to the path of independent thinking, the person who is serious about building not just wealth but wisdom, that person understands that the journey is not over. They know that this is the moment to press forward, to acquire the next tool, to complete the map. The click is not for another video, it is to continue your ascent. Complete your arsenal,